Welcome to Value Investing webinar. We talk about value investing issues, and we normally value investing, evaluating options. What crosses our mind is when to buy a stock, which is fundamentally sound. What is valuing the worth of an intrinsic worth of a company. What drives that competitive advantage, or what drives the intrinsic worth of that company, or will it be able to sustain it? Companies with moat. But today we are going to talk about something which is opposite, which is you have done all this, spotted the company, valued its worth, and being good at it. But then when to sell a stock, because that is when you realize it, when you realize your gains, or what are the triggers which will actually drive us to think that okay, it was value, but it's no longer value. So today to discuss about this is Nilesh Sethi from Quantum Mutual Fund, and welcome Nilesh.
Thank you.
So now we are not going to ask you how do you spot a company, how do you find a company, but after you have done all this, after you have done all your exercise of investing, spotting a company, finding a company, doing your estimation of the worth, when that worth is getting impaired or when things are decelerating, is it for, what are the principles which actually govern your, decision to sell a stock?
Yeah, selling a stock or identifying when to sell is perhaps one of the most hardest thing to do in the entire investing process. Most experts struggle with it. What happens is when you sort of buy into a stock, identifying a thesis, and the thesis has played out and the stock has done well for you, you tend to fall in love with the company. And then if the thesis has changed, you tend to ignore all the bad news and continue to believe this is a great company, it has done well for me, and you continue to hold on to it. For us, we've tried to put a discipline around that. What we do is, there are two reasons we'll sell a stock. One is, whenever we buy into a company, we always have a price at which we think, in terms of multiple, not an absolute value, but in terms of multiple, where we think if the thesis has played out, this is where at this multiple, this company gets expensive. And if the company sort of does well and the thesis plays out and reaches that multiple,
okay,
and there's no reason for us to change the underlying thesis, that is when we decide this is where we'll exit this company. Second is, if the thesis has changed and if the thesis that we originally invested in the company is no longer valid, we'll sort of redo our numbers and see if it's worth staying in that company. And if the revised thesis says no, it's not a company worth investing anymore, we will exit straight away. We will not continue to hold. So these are the two primary reasons why we exit a company. And the third is if we doubt the management quality.
You made an assumption that it is high quality or reasonable quality, or some assumption of quality, and that
the management does something which sort of makes us worried that as minority investors, perhaps we are getting short-changed the investment. So, the company might do well, since sort of we don't trust the management anymore, we will again straight away exit the company. Okay. These are the three broad reasons why we exit, or the decision which drives our exit from the company.
Just give me some example. Was it, where you holding Eicher Motor for its association with Volvo, and actually something else happened to the company? Was it one such example?
No, so I'll tell you when. So
because I came across a very interesting tweet by Sameer Arora. He was saying that everybody bought into that idea because they tied up with Eicher's tie with them, and then the story played out in a completely different manner.
Yeah. Unfortunately, Eicher is not a value stock for us. It's always taken.
But initially it would have been.
Yeah, perhaps. But at least when the earnings did not come through. So
of course.
But I'll give you an example. So we used to own the largest pharmaceutical company then in India, and of course it got sold out to a large Japanese player. At that time, the price offered to the minority investors was very different to the price offered to the majority, the existing promoters. And we essentially, that time we did not like it. We wrote to the board saying what is happening. We are also equal shareholders in this company. And of course, we realized not going to.
Good that you are not a promoter, otherwise you would have been in jail today.
Yeah, but essentially that time, even though the fundamentals that time suggested there was perhaps upside based on whatever was coming out, but we took a straight exit given that we sort of lost trust in the founders that time. So that's an example where we exited despite sort of
things playing out well. Okay. Yeah. Even at that time. So after the acquisition, it actually carried on. The stock market, the price.
It actually did well, but once we sort of lost trust and faith in the company, we just took an exit.
Okay. Value of a stock is supposed to be based on our expectations of a company's future. So that's to bring objectivity to the decision that there's a tendency to set a price. Yeah. Setting a price, how objective? Because things can change. So things could be relative. Like the current slowdown, a company can have a great company. Can have a bad year.
Yeah. So for us, we don't set an absolute price. What we try and do is we set a valuation multiple, which we keep on checking. Because assumption is this is the core business of a company, and if it plays out, this is where we think the profit potential or the sustainable return ratios for this company is. For such a business, we believe this is the valuation multiple that this company commands. And if it reaches that multiple and there's no change in our thesis or assumptions, we are happy to sell. What happens is, because we are looking at sort of long-term earnings, and we keep rolling over every time a financial year changes, there have been companies who've come into the portfolio and have stayed in the portfolio for 10 years because the earnings keeps on getting rolled over and they never reach the sell limits. So that ensures at least we are gaining through the compounding process and not selling out cheap by setting an absolute price target. We don't look at the absolute price. What we try and do is set multiple, and then if the earnings are rising, we are able to capture that compounding in a company.
So this will automatically translate into some opportunity where something just overshoots, the market goes crazy, a company grows by 30% every year for 5 years, and the 6th year the price earning multiple could be 60, and that could be beyond your range. And it could still sustain for a while. I'm actually coming across many examples like that. Today many expensive companies on the price multiple are the ones which are carrying on the good work, and they still look too pricey, but they have been very pricey for a long time. So do you miss such opportunity? Have you missed such?
So we've sold off companies,
kind of thing.
We've sold out companies and they've sort of gone ahead much higher from where we sold them, but that's fine. As long as what we do is we go and always recheck in our research. Have we missed something in our research? At some point, if we not miss anything in the fundamentals of the company, and based on our fundamentals, we thought this is the value.
It's a reasonably priced thing, or it's an overvalued thing.
Overvalued, and market can extend it much beyond that, and it's fine. At some point, it stops becoming a fundamental story and becoming a greater fool story, where you're buying into a company assuming there'll be a greater fool who will pay a higher price for you. And we've seen that at some point it unwinds, and then there's a lot of capital destruction which happens. What happens is, problem in research will be if you miss something, and that is when you go and sort of hammer the research team in terms of how did you miss that. But by and large, what we've noticed is it's essentially a multiple expansion driven by liquidity, which is causing these stocks to rise higher, not so much sort of a miss in research.
Or a complete concentration of the market in a certain segment at a certain point of time.
Which you saw in last 3 years before this collapse in the NBFC market, where the NBFC started trading at 5-6 times price to book, and now again there's a big collapse which has happened in their valuations. What tends to happen in markets, as long as you're not missing something in the fundamental story, you should have the gumption to be able to see that price rise and walk away from there saying this is not the kind of multiples that I want to give.
But looking at things objectively, it is hard, because what happens is that you bought something at 100 rupee, and it has gone up to 500, and it looks richly valued now. Now it looks very expensive, but simply because you bought it at 100, individual investors will think that it doesn't matter, even if I lose a part of it, even if I lose 150 of it. So how do you deal with this? Because this is something which is very natural. Your acquisition price driving your behavior.
Yeah, it is, and there is a bias there which a lot of people have come in, where if you sort of get money through a lottery or something, you tend to treat that money very differently compared to money that you earn in salary.
So this is not a lottery; it's a story which is.
So what happens is the loss through gain tends to be viewed differently than had you just lost. Even though it's the same money, right? There's no difference. So in our mind, when we account for such gains and the loss that happens, we tend to view it differently, even though we shouldn't. It's an inherent bias in humans. But again, for us, because we've sort of put a discipline through our process where we strictly follow valuation multiples and If it goes beyond that,
how rigid or flexible it is?
no, it is fairly rigid. We don't. If the valuation process is telling us this is where it has to, you have to sell this.
Is the precise absolute point at which you cut your position?
A multiple, not necessarily a price.
Multiple. Yeah. But do you actually cut your positions in a staggered way or at one go?
Yeah, for us, if the upside potential in the company, which is CMP minus where we think the target price is less than the long bond, whatever trading long bond, about 8%, then we start trimming the position and reducing it. And once it goes completely beyond the sale, and that is when we completely exit.
Is the concept of margin of safety, which is the primary driver when thinking of value investing, is there a converse of it? Do you have a very precise mechanism?
Yeah, but so most investors,
does it really become quantitative at a certain level?
Not quantitative in a sense, but sort of the opposite of margin of safety. I mean, when you're trying to sell, is you're trying to look at peak profit potential for company, and how far away is that company from that peak profit potential, and how much time does it take for that company to reach, which is what will give you the sense of peak valuations for this company, where it will be, which is what will drive. And if the company, based on that peak profit potential, if the company is trading at exorbitant value, then you come to know this is trading at extreme valuation, this is no longer worth holding. So you get a sense of, at least most investors, when they sort of invest in a company, they have a scenario in their mind in terms of what is the peak profit potential or sort of market share this company can get, and based on that what kind of profit this company can earn, based on which you can drive what is the peak valuation this company should get.
Okay, so now we move to the questions that our viewers have sent us about this particular session. Prabir Basu has this question, that how to differentiate between a company with long-term potential from that of a booming one which may turn out to be a flash in a pan in near future.
Yeah, so the key question that you need to ask is this company doing something unique which is different from others? If it's not doing something unique, then essentially it's rising because the sector is doing well, and such sort of profits or margins never last. Once the sector turns, the profits come down.
But some companies within a sector can actually, you can have lousy companies in a great sector, or you can have great companies in a
great companies in a lousy sector are doing something unique which others are not doing, which is what allows them to make sort of subnormal or superior margins compared to others, and allows them to ensure that these margins sustain over a long period of time. That is what will tell you this is a great company to invest in. If you're not able to answer that question, what is this company doing unique compared to others, then essentially that company's, whatever profit it's made, you will have competition coming in and killing that if there is no unique property to that company. So essentially laws of economics will play out. You will have enough supply coming in and destroying that profit margin. So if you have the answer which is saying, yes, this company is unique, this is what is unique about the company, which is sort of what people define as moat in the business, then you have a company which is special, and then you have a company which can sort of compound for a long period of time.
Now I have a very nuanced question coming from Chirag B. That's his name, Chirag B. How do I go about evaluating the value of an insurance company's business to make a decision for buying that stock? How to value insurance?
Insurance essentially is again inherently new sector in India, and people are still struggling to figure out how to value. Now, in a life insurance case, most companies put out something called an embedded value, which is a theoretical value of all the policies that they've written till date, which is what it's the value which the company itself gives out. If the company were to not write any
what is the basis of that?
So essentially the premiums that they think they will get over the future, they sort of do a present value to that and remove the costs associated to that, which gives you some sense of the value that they can generate from the policies that they want to get.
Their revenues
or present value of all these cash flows which they can get from all the policies that they've written, net of costs. Now, if a company were to not write any more policies, then that is the value of the insurance company, because
you are referring to a life insurance
company. Now, unfortunately in India, because most of these sectors are not that penetrated, the future policies that they can write is a lot higher number than the current policies that they've written. So what you do is, what is a new business that can come in, and you assign a value to that. Most analysts now tend to give a multiple to new business premium margin, NBAP margin, that kind of number. But again, it is highly subjective right now, because most insurance companies are being valued for the new business potential at a much higher level than what you see in the West.
Have you looked at any of these companies closely?
We have, but again, because we are value style, for us they seem very, very expensive. Very expensive.
No, because I have some questions around this. Life insurance business, there are two components to it.
Yeah.
One is that you underwrite the risk. If somebody dies, I will pay this much money, and if he doesn't die, then I make this much money.
Right.
And then the converse of that, which is annuity.
Right.
That I get this money, and I'll pay this person this much money every month, and I'll stop paying him anything the moment he dies.
Right.
These are two core work of it.
Right.
And then this is the investment business, which is almost like asset management.
Right.
So do you have enough premise to actually plan this? Liability, and when you're underwriting a risk, it's a completely different story.
Right.
But when it comes to the revenue stream linked to asset management, that's fairly predictable, and they turn out to be far robust, unlike SIPs of mutual fund, which is not a very contractual.
Yeah, you see that more in the general insurance side, where because it's not a long dated contract, it's an annual contract. They know for sure my risk ends at the end of the year.
That's a more straightforward thing to measure.
Yeah. And their sort of valuation of the investment, most of the profits actually that they make is sort of on the investment side. Underwriting, they hardly make any profit. What you see in insurance companies a lot of times, including in general insurance companies, because it's a very, very competitive industry. Even in India, you have 30-35 players in the general insurance side. What you see is they assume I'm going to make this much investment income, and they start taking risk on the underwriting side, and they start making underwriting losses, which eats into the investment income. And the more competitive it gets, the more likelihood that they are going to eat into that investment income. Again, it's an evolving sort of sector in India to see how players are reacting to that kind of competition.
Why do they run this business? Because you can just have your investment income.
Because of market share. They believe that if they want to gain market share and survive in the industry, because again, your costs are getting...
Because it's your capital. You can keep making money on that. Why underwrite a risk?
Yeah.
Where you tend to lose money.
But again, the assumption is I'm losing some money, but I'm gaining some money on the investment side. Net, I'm still better off. But
how? Because these are 1-year contract. You don't get money for a long period of time.
The assumption is if I scale up, my cost doesn't dramatically change, right? And I hold lower costs. So hence the objective is to scale up as much as you can quickly, and that gives you a competitive advantage versus someone who's coming new into the industry. So I can price policies at a much different level than he can, because his cost structures are not spread out over that many policies.
Achieving a scale and result of that. Okay. Manmeet Singh is asking, one of the companies which I invested into has merged with another company. Do I hold the new stock or sell it since fundamentals of the business are no longer the same? So I think his question itself has an answer.
Yeah, you have to go back and essentially do a sort of recheck of the thesis. If you like the new company, the way it is structured, and you think...
No, he's clearly saying that, sell it since fundamentals of the business are no longer the same. I hope, he's referring that it has, changed for worse.
Yeah, if it's changed for worse, then you exit, right? You don't wait. But if the same can be either way, it can improve.
It can improve it, achieving a scale, getting some advantage. Okay.
So whatever the answer that he gets, based on that he can decide.
Ashim is asking that I'm a long-term investor, but I find that even after investing for a long period, over 8 years mostly, some of the stocks are now penny stocks or negative return stocks. What do you suggest for long-term investors for such cases? Unfortunately, the stocks don't know that Ashim has bought these stocks.
Yeah.
And so how to deal with this?
Yeah, I think...
Sorry.
One, the fact that most of the stocks that he's invested in has become penny stocks is perhaps telling him that he's not a great stock picker, and he's perhaps going lower down the quality scale in terms of picking the companies to invest. Perhaps for him, just to understand the market and how to go about investing, by sticking to quality names initially in the first few years, and then figuring out how companies move based on earnings. Perhaps that will give him some sort of experience in doing better stock picking. But that's sort of my advice.
I have an easy answer for him. 8 years is a long period of time. You have demonstrated that you are a long-term investor. You have also demonstrated that you have patience. You have allowed your stocks to become penny stocks. So stop this and start investing in an equity fund and do your SIP. And what Nilesh is saying, do it with 5 stocks and do it for a very limited amount. Regain your confidence. Maybe that's because it requires time, inclination, interest, understanding, and it is not an activity which can be just done on the side for the heck of it. So till that time, be on with your mutual funds. Lalit Samardivakara has this question. For how long do you stop yourself from selling a value stock when a long-term period of 5 years is also not profitable? How patient are you with your investments when things don't play out?
Yes, so equity unfortunately can be very lumpy in the nature of returns that they get. You can have 5 years of zero return and 1 year of straight away 100% or doubling of the stock, and you still make your long-term CAGR.
Like I said, you have had such situations?
We have had. We used to own oil marketing companies which were available at deep discounts or replacement, and for a few years they did not move, and suddenly one day regulatory changes happened and they all sort of doubled in 1 year. Mm-hmm. So, I mean, the key point is you should know the catalyst why you've invested in that company. Okay. And sometimes you might not know the timing of when it will play out. Which
that turns out to be a good test of patience.
So. Yeah, but as long as you know what is the reason you invested in, and you might want to continue to hold on to that company. Apart from the fact that if the balance sheet is deteriorating for the company, then you should exit. You should not. But you think the company is a solid company, but the catalyst you're not sure when it will play out. You just holding on to that company and just allowing whenever the catalyst play out allows you to make your long-term CAGR return. That is what we've seen in our investing cycle.
Similar question. Thomas Anderson is asking that I am owning a stock for 3 years now. However, due to overall market cycle, it has not been able to rise much till now. Looking at markets, it might take some time to recover from slowdown, which will increase the time for the stock to achieve its value. Do I sell the stock and look for better opportunity?
So you have to delink your view on the market and the stock. If you try and predict where the market is heading and based on that decide stock positions, then at least we are not an expert in that. We don't look at markets.
Even you can't do it.
Even we can't do it. So what he has to do is just to go and check the company. What is the reason he bought that company? Does he like the company and the management and what they're doing? If he still likes them, forget about where the market is headed. The company will do well over a long period of time if it's a good company with inherently good story.
A very interesting question. Ashish is asking that as a value investor, how many stocks are too many?
Yeah, I mean, my answer comes from a fund's point of view, not so much an individual. So we don't like to have very small positions in the portfolio. So a minimum allocation is at least 2% in a company of the funds.
2% will actually make it 50 positions.
Yeah, if you have all that minimum positions, but in some cases we have 5 or 6% in a company.
You don't exceed more than 5-6%?
At cost. At market value it can go up to 10%. So roughly what we've seen is at positions sort of ranges between 25 to 40. 40 was just after Lehman collapse and you got a lot of names. Generally, nowadays it's around 25. But this is because we have a large research team doing research. For an individual, it's not that easy to keep track of all such investments. So based on the time available, perhaps he has to decide how many companies he can dedicate his time to follow up in terms of what is. Yeah. And based on the time, perhaps he can then decide how much he can do. Because we have a large research team to do a lot of research on these companies. So we can have a much larger number. But for him, it will be scaled down quite dramatically.
Dr. Vishnu is asking that in value investing we talk about blocking our external noise when holding period of a value stock. However, we should also talk about cutting out losses when a particular stock fails to achieve its potential value. How and when do I make a choice between the two principles so as not to lose out on potential gains by exiting early but also not incur losses in case of a value stock going bust?
I mean, it's like I said, you have to go back to the thesis of why you invested. If the thesis is changed, then it's no longer the same company. You have to cut your losses and exit from that.
So facts change, you drop your stock.
Yeah. But most of the time what happens is, like you said, there's a lot of noise around. See, India is going to slow down, markets are going to come down, most stocks are about to fall. That is not something that should drive your decision. So company specific news which changes the story of the company, that is what you should focus on. External noise about FI flows, FIs withdrawing from India, slowdown in the market or something, that is something you should ignore.
Thank you, Nilesh, for sharing your insights with us. To all our viewers, wishing you a very happy Diwali and keep coming back. Thank you, viewers, for watching us time and again in such large number. We never expected this to succeed the way it has. And I have two things to urge you, which is share these videos with your friends or family members whom you think it will be of interest to them. And other is suggest us ideas and make your suggestions about what you would like us to talk about.